What's going on, traders? It's Mike from CapitalHillFX, and today I am super pumped because we're going to be going through a webinar regarding everything risk management. And if you want to be a successful Forex trader that sustainably trades the markets, you need to understand risk management. You need to implement logical risk management practices that allows you to sustainably trade the markets. And today we're going to start off by introducing what risk management is, and then we're going to go into the major components that make up risk management. So let's start off with introducing what is risk management. Well, when you're trading currencies in the foreign exchange market, it comes with inherent risk, right? And these risks needs to be identified, assessed, and mitigated. With this being said, it's therefore essential for traders to have a comprehensive risk management strategy in place. And there are two main ways that you manage risk in the foreign exchange market. And most people are very familiar with the first way. It's using a stop loss. What is a stop loss? Well, stop loss order is a risk management tool in Forex trading that closes a trade at a predetermined point if the market moves against you. So you have your buy order around a significant horizontal level, right? And you're anticipating that price is going to move towards the upside. But what if price moves towards the downside, right? The opposite direction that you anticipated it was going to go in. Well, you don't want to stay in that trade forever, because if it just keeps going down and down and down, you're just going to keep losing more and more and more money. So you want to have a certain point on the chart where you want to take out of that position just to not incur any more loss. And this is your stop loss. So stop loss orders can help limit potential losses and protect profits. So if we look on the right-hand side, this is our entry right here, we're trading a bounce off of a horizontal level. We can see our stop loss is at this point. So if price just smacks towards the downside, we will then be exited at this point on the chart so we don't incur any more loss. And then I have right here, ideal to set stop losses at below or above quote unquote invalidation zones. And what are invalidation zones? Well, I like to point out invalidation zones whenever I'm placing trades, because invalidation zones give you a better idea of where you don't want price to head and be in that trade any longer. So let's say we're trading a bounce off of a daily horizontal level. So we would put our invalidation zone below that zone. So we say if price breaks that structure, we don't want to be in that trade any longer. So we can see right here, if we're trading a bounce, and let's say this is a daily horizontal level, our invalidation zone would be below these previous wicks, because if price just closes past these previous lows, we no longer want to be in that trade because it's breaking the structure, and we're trying to trade off of the structure. So it doesn't make sense logically, if price breaks the structure, to be in the trade any longer. Our sentiment is no longer valid. So this is where you'd want to place your stop losses. Now, let's say you're placing a sell at a resistance level, right? You'd want to place your stop loss above that resistance level and have an invalidation zone above the resistance level, because you're saying to yourself, okay, if price is going to break through a resistance level and I'm trading off of that resistance level, then it's probably not going to end up bouncing at that resistance level because we broke through the structure. So you always want to have an invalidation zone in the back of your head. Maybe you're trading moving averages, MACD, Fibonacci retracements, or bounces off of horizontal levels. You always in the back of your head want to have an invalidation zone in place marked up on the chart, so you know when you want to exit your position. This is usually when you want to place below or above the stop loss. So stop losses are very simple and very straightforward, right? Just takes you out at a predetermined point to not occur any more loss. Now let's look at hedging. Hedging is a little bit more difficult and not as simple as a stop loss, right? Most new traders don't even know what hedging is. So we're definitely going to take a look at it right now. Hedging involves taking an opposite position to an existing trade in order to offset potential losses. This allows you to make informed trading decisions after price has moved against your position without closing in loss. So let's take a look at the left-hand side here, this little screenshot. So we could see in this example, let's say we placed a sell around the significant horizontal level. Let's say this level is a significant resistance level, right? And we're forming a lot of bearish price action. So after a couple bearish impulsive candles, we end up entering a sell. So instead of placing a stop loss, we would place what's called a hedge order. So in this case, it would be a buy hedge. So let's say price just starts whipping towards the upside against our original position. We thought that price was going to go towards the downside, but it ends up heading towards the upside. So instead of getting stopped out like we would with a stop loss, instead of getting exited in loss, we would actually enter another position, but it would be the opposite position that we initially entered. So right here's a sell. So if it started smacking towards the upside and started skyrocketing, then we would enter a buy. And the reason we would enter a buy is because it would offset any of the losses from the sell. So this means if we started skyrocketing towards the upside, we would gain profit from the buy, but we would be losing money from the loss. So theoretically, we wouldn't be losing any money because we would be gaining money from the buy, and we would be losing money from the sell, but we would still be at the same exact amount of loss. So it pretty much just offsets potential losses. And the reason you would want to do this is because you are able to make another informed trading decision, and you don't have to close out of this position at a loss. So let's say we have a significant resistance level up in here. And I know it's a completely different screenshot, but let's say we had a significant resistance level above this buy hedge. So what we would do is we would wait for price to skyrocket towards the upside and go into this significant resistance level. Then we would close this buy hedge in profit. Cha-ching. And then we would place a sell at the resistance level because it is a daily resistance level, right? And if price was able to make a bearish impulsive move off of that significant resistance level, we could then cash out off of that sell order, and we could close out of this initial sell order at a smaller loss. If this is all very confusing to you because you're not actually on a chart, make sure to go to my previous YouTube video where I go over everything regarding hedging and even stop losses. And I go over all the different ways that you could manage risk on a chart. This is more of a PowerPoint presentation. It's more superficial, going over the facts. But if you actually want to go over in depth into the technical analysis side of things with risk management, make sure to go to my previous YouTube video. I think it's called Everything Risk Management or Hedging and Everything like that. It will give you a much better depiction of how I use hedging in the charts. But it makes a lot of sense to use hedging if you are controlling risk in the foreign exchange market because you don't have to close out in a loss, and it usually results in a higher winning percentage. But if you're a new trader, I highly recommend you just starting off with stop losses because hedging could be very overwhelming, especially if you don't know how the markets move. So yes, hedging is a very good way to manage risk in the foreign exchange market. And place the hedge order in the same position you would a stop loss. So like I said, considering we have our hedge order right here, this is where we would place our stop loss too, just above or below those invalidation zones. So that is hedging in a nutshell. So those are the two main ways to manage risk in the foreign exchange market. Now we're going to go over the major components of risk management. So there are 5 major components that you need to manage risk effectively in the markets. The first is risk per trade. So let's actually go through risk per trade. So traders must ask themselves, how much of my account balance am I willing to lose per trade? Determining this amount and staying consistent is so crucial. There are so many new traders that start off by trading 50%, 40%, 20%, 70% of their account balance, and they're always fluctuating, right? You need to have a consistent amount of what you're going to risk per trade of your account balance. A good rule of thumb is only to risk 1 to 3% of your account balance per trade. Only 1 to 3% of your account balance. Most of you are risking 10, 20, 30% of your account balance. So that if you lose 5 or 6 trades in a row, actually because it's only a matter of time when you're going to go on a losing streak. Remember, it's naive and ignorant to think that you're never going to go on a losing streak. So when you're going to go on a losing streak and you lose 4 or 5 trades in a row and you're risking 10 to 15% of your account balance on each one of those trades, you could lose literally 50 to 75% of your account balance in 5 trades. That's not good. But if you're only risking 1 to 3% of your trades, what do you lose? 5 to 10%? 5 to 10% loss is completely different than 50 to 75% of your account balance. So that's why it's very important. Small, consistent wins. Remember what I said from the beginning, sustainably trading the markets. We are long-term. We are not short-term traders. If you're a short-term trader, then you're not going to make money. You're just not going to make money if you're thinking short-term. If you're thinking 30-day terms rather than 30-year terms, you're already setting yourself up for failure. So that's why you need to trade 1 to 3% of your account balance so that you can sustainably trade the markets, and you're looking for small, consistent wins, and you're optimizing on the risk to reward ratio rather than trying to make millions or thousands off of one trade. You're trying to quit your job off of one trade. And that's why a lot of traders, they risk 100% of their account balance. They show that they doubled, tripled, quadrupled their account in 2-3 days. And then what ends up happening? They have a bad trading day and they lose their whole entire account. That's not what we're going to do, right? There are going to be bad days with trading, but that doesn't mean you should blow your whole entire account. That means you should only risk 1 to 2% or 1 to 3% of your account balance and sustainably preserve the account. So Only risk 1 to 3% of your account balance. The example right here, if you have a $1,000 account balance, you're only risking $10 to $30 per trade, right? And this is why prop firms are so valuable, because you need higher account balances to have consistent cash flow that allows you to quit your 9 to 5. So you need a $50,000, $100,000 account balance to make an actual good return on a week-to-week basis to sustainably trade the markets or to sustainably live your life and pay bills. So that's why once you have a profitable system, you should go to a prop firm, because they will provide you capital to trade the markets, and they will give you $100,000, $200,000 worth of capital to trade consistently. Don't try to flip $1,000 into $10,000 and live off of that. Instead of doing that, if you have a profitable system, go to a prop firm. They'll give you a lot of capital to sustainably trade 1 to 3% of your account balance. So risk per trade is huge when having an effective risk management practice. The next is position size. Let's go into position size. So to properly leverage your account, you must, and again, we have the capital letters here, you must utilize a position size calculator before every, capital letters, every trade you place in the markets. If you are not utilizing a position size calculator before every single trade that you place in the markets, you are improperly leveraging your account. You're just not leveraging it properly. So you need to use a position size calculator. This is the most effective way to sustainably trade the market. So if we look on our left-hand side here, we can see the couple different pieces of criteria that we need to fill out with a position size calculator. The first is the currency pair. What currency pair are we trading? This would be Euro USD, let's say, for example. The next is your account currency. Are you from the UK? Are you from the United States? Are you from South Africa? What is your currency? What is your local currency? Mine's the US dollar, so USD right there. Next is our account size. So this goes back to the first one. What's your account size? Is it $100? Is it $1,000? $50,000? What is your account balance? Put it in right there. And how much are you willing to risk? This goes back to the first one as well. How much of your account balance are you willing to risk? Is it 1%, 2%, 5%? You could also swap it with money. So instead of putting the percentage, you could put the actual dollar amount. And then your stop loss and pips. Is it a 50 pip, 100 pip, 200 pip stop loss? If you're hedging, it's the same exact thing, right? It's the same amount of pips as you would for your stop loss. So is it 50 pips, 100 pips, 200 pips? You could put it in there. And then you press calculate, you press calculate, and voila, you have your correct leveraged position size and your lot size. So we can see right here your position size calculators. This right here on the left-hand side is my FX book. It is a browser. It's not an app. So if you are placing trades on your laptop, there's no reason not to go to my FX book, and I'm not affiliated with them by any means, but it just makes the most sense to use a free calculator on a browser when they have it. So go to my FX book and they will provide this free position size calculator. But if you're placing trades on your phone, I highly recommend you getting Stinu, and it's not my app, not affiliated. I'm not referring you, but it's a really good user-friendly app that allows you to effectively manage risk and calculate your position size on an app. It's very user-friendly. It's paid. It's like $15 a year, I think. So if you're actually going to be trading Forex, like if you're serious about this, you should get the paid version. Like you should get Stinu just because it's so easy. The app is like so user-friendly, and it's so much easier than going through my FX book, clicking out the pop-ups, going through the browser. Like it's so much easier to just go through the app and just do it, but it's up to you what you want to do it. Some of you spend $15 on lunch today. Like you could spend $15 a year on an app that's going to help you in your journey. So you need to have the effective and correct position size to sustainably trade the markets, and this is where a position size calculator comes in and helps you. So we went over risk per trade. We went over position size. The next is leverage. A lot of people don't understand leverage, so I'm going to break it down for you. Leverage in Forex allows a trader to gain more exposure than their initial deposit. So let's say you deposited $1,000 into a Forex account, right? This doesn't mean that you could only trade $1,000. This means that you could trade more than $1,000 based on your leverage. So your broker, Forex brokers will provide leverage based on the leverage that you choose. So let's say you have 50-to-1 leverage. This means if you invested $1,000 into a Forex account, they would 50 times your investment. So you would be able to, your purchase power would be $50,000. So you can invest up to $50,000 of capital into trading the foreign exchange market. Now, this is a double-edged sword though, because the more that you have with leverage, the more you risk actually. So this isn't just good like upside, right? There's also downside to having high leverage. So we're going to go over what leverage makes sense for your financial goals. So choose the proper leverage based on your financial goals. So if you're looking for small, consistent wins and you're only risking 1 to 3% of your account balance, then you don't need much leverage. You only need 10 to 1, maybe 50 to 1 leverage to be able to get through your journey. You just do. And that's why regulated brokers are so great, because they only provide 50 to 1 or 25 to 1 leverage. But that's all you need if you're trying to trade small, consistent gains, because you're not risking much of your account balance. So you don't need much leverage. But if you're looking for high risk, high reward strategies, you're risking 30%, 40%, 50% of your account balance, and you're looking to compound your account quick, you need high leverage. So you need to go with those unregulated brokers. You need 200 to 1, 500 to 1 leverage to be able to get those high risk, high reward strategies. So it depends on your financial goals. Are you looking for small, consistent wins? Are you looking for huge wins of your account balance? You're trying to flip a $100 account into $2,500. You need high leverage if that's going to be the case, because you need that leverage. You're looking to risk a lot of your account balance. So this is sort of leverage in a nutshell. And the power of leverage allows you to start a small account, right? Allows you to trade with $25. If you're looking to trade stocks and you're looking to try to get a real good return on stocks, you're not going to make much money with $25. And the reason is because stockbrokers do not provide leverage. They only provide like maybe 2 to 1 leverage, maybe 5 to 1 leverage. But you'll never see a stockbroker providing 50 to 1, 100 to 1, 150 to 1 leverage. It just doesn't happen. And that's why Forex is phenomenal, is because it allows people who are actually knowledgeable about the space and have a profitable system to start with 50, $100 and actually getting a return on their investment if they use it wisely. So the power of leverage allows you to start a trading account with $50, $100, and you could have the opportunity to multiply it to thousands of dollars. If you're knowledgeable, if you're a new trader, then you're probably not going to be able to do it. Just plain and simple. So that's leverage. So we went over risk per trade, position size, leverage, and now a very big one, risk to reward ratio. Risk to reward ratio is a way to measure a trade's potential profitability compared to its risk. So I think the best way to look at this is looking at this screenshot on the right-hand side. So we can see we have our reward on the top and then our risk on the bottom. Sort of similar to what I showed you on the stop loss and even the hedging. You can see that we had this green section of the area and this red section of the area. So the red is our risk and the green is our reward. And this is basically saying in this screenshot right here, if we risked $1,000 on this trade and we lost, we would lose $1,000. But if we won, if it smashed towards the upside and it hit take profit, we would win $2,850. That's basically what it's saying. So it's saying every time we hit take profit on this, we would win 2.85 times more than we lost, right? So we're risking $1,000 to make $2,850. So that's a 2.85 to 1 risk to reward ratio. So we could see, or 1 to 2.85 risk to reward ratio, excuse me. So we can see on this chart right here, if we have a 1 to 1 risk to reward ratio, basically saying we're risking $1,000 to make $1,000, it's 50-50 shot, right? There's a 50-50 chance that we're going to win or lose that trade. And we would win $20 to lose $20, right? But if we have a risk to reward ratio of 1 to 5, although it's very unlikely that we're going to hit that take profit because our reward is huge and our risk is very small. So there's like a near 17% chance that it's going to hit take profit. But when it does hit take profit, we're going to make $50 compared to losing $10. And this happens, a lot of people do this, right? A lot of people utilize like a 1 to 5, a 1 to 10, a 1 to 20 risk to reward ratio. So they're only winning like 5 to 10% of the time, but the times that they're winning, it out trumps the times that they lost. So they'll make $500 on that one win, and then they'll lose their next 5 trades, but they're only losing like $25, $50 each one of those trades. So they only lost like, I don't know, $250 from all those combined losses, but that one winner gains it all back. So you have to get a good idea of what your optimal risk to reward ratio is. And the best way to do this is backtesting your trading system. In my subjective opinion, I think the best way to find an optimal risk to reward ratio is backtesting your trading system and even in demo. So have a logical risk to reward ratio is another very core tenet to risk management and implementing logical risk management practices. Then last but not least, we have is discipline. Discipline is huge. So the others are very black and white, right? Like position size calculator, your risk per trade, and even risk to reward ratio. Those are very black and white, right? Like you completely understand them, and they're very logical. But this is very gray. The discipline, the emotional connection that you have with trades, your psychological aspect of trading is very gray. So this could go in one ear and out the other, because the only way that you'll actually understand this is going through it. So let's go over discipline. When risking money in any financial market, it's imperative that you manage your emotions accordingly. So don't let greed, fear, boredom affect your trading decisions, because it may expose you to improper risk. Develop a rule-based strategy that becomes more binary. I always say make sure that you have trading criteria for what triggers you into a trade and how you should be managing that trade based on the criteria. Do not let emotions, hopes, and feelings fuel your trading decision, because any trading decision made off of emotions, hopes, and feelings is always a bad trading decision. You need to leverage statistical data by backtesting your trading system and look at the markets objectively by just looking at the price action and market structure. That is the best way to have discipline in the markets rather than being fueled by your emotions, hopes, and feelings. If you have good discipline in the markets, then your risk management will be superb. But if you don't have good discipline in the markets, you're letting emotions dictate your trading decisions. It doesn't matter about how much you're willing to risk. It doesn't matter about the leverage. It doesn't matter about your position size. You're going to fail. You're not going to sustainably trade the markets, because discipline is huge when you're trading the markets. And the only way that you really gain discipline is by being able to have the statistical data and intuition. So leverage statistical data and not emotions, hopes, and feelings like most new traders do. Like I said, most new traders step into the space. They see an impulsive candle towards the upside, and they say, oh my God, I need to buy. Oh my God, I need to FOMO into the trade. Oh my God, I see a profitable trader trading this exact market. I need to trade it. But the problem with that logic is you don't know why you're placing into the trade, so you don't know when to take out of the trade. So if it's going into drawdown, now you're going to take out of the trade just because you see red on your screen, but then you see it go back towards the upside in the original direction that you anticipated it. And that's because you don't have data. You don't have criteria. You're going off of emotions and feelings. You need to have statistical data. You need to have set criteria. You need to have a rule-based strategy that becomes binary. You need to just check the box. Okay, does it meet this? Okay, good. Does it meet this? Good. Okay, does it meet this? Good. Okay, I need to place into the trade. No, that's not what most of you are doing. Most of you are leveraging your emotions, hopes, and feelings, and that's why you're failing in the markets. So make sure that you are very disciplined when it comes to the foreign exchange market. And that is everything when it comes to the major components of managing risk in foreign exchange market. So just wrapping up, because a lot of you may see this and be like, Mike, there's not much here. Well, this is basically everything. Managing risk in the foreign exchange market is very simple. It's very simple. It's all of these components. What is your risk per trade? What is your position size? What is your leverage going to be? What is your risk to reward ratio going to be? And how disciplined are you going to be in the markets? And we'll go back to the stop losses. Are you going to utilize stop loss or hedging? Which one of these are you going to use? And make sure you have everything else figured out. Sorry about that. This is Mike from CapitalHillFX. I hope you learned something from this webinar, and I'll see you guys on the next one. Cheers.